Committing to just 500 rupees every month produces a mathematical outcome after 10, 20, or 30 years that is difficult to visualize without a calculator. To keep these experiments grounded, we are using a specific baseline. We will assume investments in Indian equity mutual funds, which have historically averaged a 12% annual return over long-term cycles. On this interface, we have plugged in 500 rupees for the monthly investment and locked in that 12% expected return. By hiding the inflation and top-up tabs, we can isolate the single variable of time. Adjusting these specific variables allows you to move away from general estimates and begin engineering a specific financial outcome. This chart tracks our 500 rupee investment. By year 10, it reaches 1.1 lakh. At year 20, it crosses 5 lakhs. Growth is initially flat, but by year 30, data diverges. Your 1.8 lakh out-of-pocket investment generates 15.8 lakhs in returns, totaling over 17.6 lakhs. This gap exists because the human brain defaults to linear logic, expecting a steady pace. But mutual funds earn interest on top of previous interest, creating a curve that accelerates over time. This research paper on the power of compounding explains that the value of an investment grows at a geometric rate rather than an arithmetic rate. Reinvesting earnings allows the principal to grow continually year on year. The duration of the investment builds the bulk of this wealth, far outstripping the impact of the initial monthly payment. While 17 lakh rupees is a significant result for a small contribution, it falls short of an aspirational lifetime target like 5 crore rupees. To reach 5 crores in 30 years with a flat monthly payment, the calculator shows we must invest 14,200 rupees every month. For a young professional, committing to this flat 14,000 rupee investment for 3 decades is often financially impossible. A static investment plan ignores the reality of career growth. It places the highest financial burden on the investor when their income is likely at its lowest point. The Step-Up SIP addresses this by automating an annual increase in your contribution. As your salary grows, your investment grows by a fixed percentage. This data table on top-up investments shows how these incremental additions change the scale of the compounding sequence. A 10% annual increase in the investment amount results in a significantly higher closing balance in the final years. Consider the math if you start with an affordable base of 2,000 rupees a month, but automate a 15% increase every year for 30 years. The calculator shows a final value of roughly 4.5 crore rupees. This happens because the step-up structure increases your capital contributions exactly when the compounding multiplier is most effective. The step-up feature connects your current budget to your future career growth, allowing you to start small while still reaching a multi-crore target. Comparing these paths side by side, the left is a flat 14,200 rupees. The right starts at 2,500 rupees with a 15% annual increase. Despite the smaller start, aggressive scaling later yields 5.6 crore rupees, outperforming the flat strategy. 3 rules. First, time and the market beats high starting amounts. Second, assume 12% returns. Third, use a step-up to match income growth. Mastering the step-up variable makes compounding an active wealth strategy